Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hey everyone, welcome to the 28th episode of Carson's Facts versus Feelings with Ryan and Sonu. I'm the Chief Market Strategist here at Carson Group. Sonu, give us your title real fast before we dive in.
So Vice President, comma, and I think the comma is important here, Global Macro Strategist. Maybe the comma is and or Global Macro Strategist, but that's what it is.
Yeah, we actually got in trouble last time. We messed our titles up, so sorry, compliance. We got our titles right. We have Sam Rowe. Sam, what is your title, just so everyone's compliant here?
I am the founder and editor and I guess the writer and the head of HR, the CFO of TKer. I write an investment newsletter for people who have equities as part of their long-term strategic allocation.
There we go. So I'll jump in. So a little bit of a joke there, but we are so honored, Sonu and I, to have Sam on. We've been huge fans of Sam for a long time. He's going to talk a little bit about his career, kind of where he sees the world, but it's just going to be exciting for sure. And again, this is the 28th episode of Carson's Facts versus Feelings. But Sam, I've got to start off with one question. We're doing this a little bit early. We're doing this the week before people listen to this, just so you know that. But the reason is because Sonu and I are going on spring break next week. Sam, have you been working on your spring break body? You going anywhere? What's happening with the Rose here?
We won't talk about my spring break body.
I know,
but
that goes for me too.
Yeah, as far as trips are concerned, I was actually on Expedia this morning looking at what the options are. It's a combination of, all the dates are either wrong or it's a little bit too expensive or more expensive than I remember it.
Well,
so I'm on hold for now. Where are you guys?
I'm actually going to the Turk. By the time someone listens to this, I should be on the beach at the Turks and Caicos, probably drinking one of those. I'm going to drink a lot of those drinks with the umbrellas in them, those fruity drinks with the umbrellas in them is hopefully what I'm doing when someone's listening to this. Sonu, where are you headed next week?
I think by the time this episode comes out, I'll be in Legoland in San Diego.
Don't knock it over.
Yeah. But hopefully we can get out of Chicago because I think, most of the city is out because CPS, the Chicago Public Schools, have this spring break. So you can imagine what the airports may be like over the next 2 days.
Wow. Well,
hopefully nobody's stopping in Chicago this weekend for layovers.
Exactly. Well, hopefully everybody has a good spring break, and we're just going to jump right into it. Sam, first things first, we were half laughing. Some people call your company TKer, some call it TKer. What do you call the name of your company?
That's a great question. The short answer is I call it TKer.
Yep.
But the story behind it is, so TKer operates off of the Substack platform. And so about a year and a half before I actually launched the newsletter, I sat on a sort of a placeholder URL on Substack. And I didn't have a name for what this could possibly be. So, using an old journalistic trick, I had a placeholder title as TKTK, which is a shorthand for that journalists often use in place of headlines, suggesting that the headline is to come. So it hasn't been written yet. And then, I played around with a couple of ideas for what the newsletter's name was going to be, and I just wasn't really happy with any of it. And then I just saw the placeholder, and there was something about TK and the sound that made it a little bit of sense. And then I swapped out one of the TKs for an ER, and, TKer means something in finance, doesn't it? It means something in life. There's all kinds of interpretation as to what TKer could possibly mean. Your heart's a ticker. But at the end of the day, the thing that was most attractive about it was that it was a very short name. And as some of us know in terms of branding, it doesn't start with the word the. So, and now you have TKer.
There we go.
Fascinating.
That's good. Sonu, go ahead.
No, I was just, you mentioned your journalism career. So obviously, Ryan and me reading you for a long time, I mentioned that I've been following your work, goodness, for more than a decade since you were at Business Insider. And I think you went to Yahoo. Talk about that transition and how you ended up going sort of independent and where you're, I guess, approving your own PTO as well, I suppose.
Sure. The origin story actually goes back a little bit further. So before I was at Business Insider, I was actually at Forbes working for the Forbes newsletter division.
Right.
And at the time, and I think it's still the case, Forbes' newsletter division, Forbes actually ran continues to run a couple of investment newsletters outside or inside the Forbes umbrella, but separate from their news products. I used to write for what's now known as the Forbes Investor newsletter and the Forbes Special Situation Survey newsletter. And these are two stock picking newsletters that kind of fly under the radar, and I think they're all happy about that actually. But yeah, for about 4.5 years, I helped research and write up stock picks for these two newsletters. And it was at that time I was enrolled in the CFA program, got through all of that good mess and everything. And as soon as I completed the CFA program, the financial crisis hit, and I lost my job. But that was a very brief period where I did a couple of odds and ends types of jobs, but I continued to blog during my free time. And fast forward a couple of months, I saw a job opening at Business Insider and joined that team and became the editor of their markets team. And I worked with Joe Weisenthal when he was still he's currently at Bloomberg, but Joe Weisenthal at Business Insider, we worked together for about 4 years to help build out their markets team. And
that was a fantastic team, by the way.
Yeah, we got the attention of people like Sonu and people who were serious with their money, and we got both the attention of not just retail investors, but a lot of folks on the Wall Street side and the financial services industry side, because we were just really rigorous about getting really great information out to our readers, and it wasn't about just having doom mongering headlines and stuff. But yeah, fast forwarding a little bit, after Business Insider, I ended up at Yahoo Finance, where I was their managing editor for about 5 years. I worked with Andy Serwer, the editor-in-chief at the time, to sort of overhaul their operations over there, their editorial strategy. And during that time, we were able to launch 8 hours of live TV programming and live online programming. And I know Ryan continues to appear there quite a bit. Massive audience. It's unbelievable to think about how many people come to Yahoo Finance every day. And we were able to serve them, and the response and feedback was great. And then, I kind of got an itch to get back to writing. And things were, kind of maturing over at Yahoo Finance for me in terms of my career. And so I wanted to try something a little bit different. I briefly wrote the Axios Markets newsletter. And then I got this opportunity to start, my own newsletter through Substack, and here we are.
Well, that's did you work with Phil Perlman? Phil, we had Phil on our podcast maybe 2 months ago. Did you work with Phil at Yahoo?
I just missed Phil. Phil had, I think I joined, maybe 2 or 3 months after Phil. But Phil, a great guy. Just saw him a couple weeks ago. Yeah, awesome guy.
Well, so you mentioned one thing, and I want to. There's so many ways we can take this conversation. Just so excited you're here. You mentioned the doomsday headlines that the media have, right? Literally, Sam, as we're recording this, S&P was up 7% last quarter, going to be up maybe 6% this quarter. That's 2 pretty good quarters in a row. Yet, if you turn on TV, you turn on the headlines. Let's be honest, in the media, sometimes it's not. I don't know. It just seems awfully negative. How do you, as someone who's in the industry, writing amazing research, and we're going to talk more about TKer and how people can sign up for it and what you're doing soon. But how do you do that delicate dive between not sounding too negative or sounding too positive?
Yeah, no, it's tricky because especially in media and news, there's from a business perspective. There's a really tricky balance between serving the audience's needs and serving the audience's interests. and sometimes they're interested in hearing, the bad news and the scary perspectives. And psychologically, we know that the eyeballs tend to gravitate in those kinds of directions. And so the data tells us that, we need to give these precautionary tales because that's what the reader wants. But obviously, there are feedback loops that occur and that kind of thing. But, I think the thing that really sort of opened my eyes to things was when I began working with Joe at Business Insider. And, he was really great at communicating how exciting good news can be. Mm-hmm. And so the real challenge was not so much just, throwing facts out at people, but like framing it in a way where people understood, what the stakes are and why it mattered, why the good news mattered, and why you should get excited about good news. And so, yeah, it is a tricky balance because it's very easy to blow things out of proportion. But sometimes, a jobs report is really exciting and you have to have fireworks in the picture and you have to have all caps letters in the headlines. And that was a way for us to, get the audience's attention. And people start to realize, wait, hang on a second. For the last 5-10 years, I've been reading all these doom headlines, but the S&P 500 has gone from 600 to 2,000 to where I am right now. Maybe it's these positive headlines that are telling a better, a more fair, painting a fairer picture of what's actually happening. And so it in the same way that doom headlines, part of the reason why they're so successful, they tap into emotions. The challenge was trying to figure out how to get, optimistic things, bullish things, and, maybe things that are just sort of business as usual to get readers excited about that.
Yeah.
That's awesome.
Interesting.
On that, you just wrote about how the S&P is constantly changing. I'm thinking about the optimistic view, and markets go up all the time, but we hear all these doom headlines. I mean, most recently SVB and Signature, and I didn't realize until I read your piece that they were in the S&P and they were taken out and they were replaced. The S&P 500. I mean, if you think about it as buy and hold it forever, right? But that index is constantly changing, and that's a sign of capitalism growing, as you nicely wrote. Talk about that.
Yeah, it's really easy for a lot of people to just say, passively invest in an S&P 500 index fund. It's boring, but it's so hard to beat this index and all this stuff, and then move on from that. And it's fine. It's fine to have not a very sophisticated view of how the S&P 500 works and index investing works. But when you start to really dig into how it works, it actually is a lot more exciting and much more interesting. And you start to understand why it's so hard to beat the market.
Right.
But so I wrote earlier this week. People can find it on TKer.co. And this is new data that S&P Dow Jones Indices publish, and they update this every once in a while. But on average, about 5% of the S&P 500 names get turned over every year. Now, it's on one hand, it's a small number. It's about 25, 26 names per year. But over time, the whole entire index might turn over
right.
Within your lifetime. And what does that tell us? It tells us that the S&P 500 is, I wouldn't go out and say it's active management and trading, but what it does do is it allows for the index to eventually weed out, what companies that might be laggards in terms of stock price and profits, and make way for new up and coming names. Names like, Amazon and Alphabet, weren't added until, maybe 10, 15, 20 years ago. And, if you bought an S&P 500 index fund, 30 years ago, or if you bought the 500 stocks and just sat on them, then you're missing out on, a handful of names that are driving some massive outsized returns. So, when you do something like index investing, like in an S&P 500 fund, you're very much participating in the machinations of capitalism that right. destroys companies, while also seeing small companies come out of nowhere and become top of the heap.
I love that piece, by the way.
Yeah, I mean, Sam, I think what I'm such a fan of with what you do at TKer You go out and read the big reports from a lot of the banks, institutions that are like 50 pages that I'll try to look at and my eyes just glaze over. I can't do it. What I love that you do, you go through it and you find one or two charts that matter, that are impactful. So I don't have to go do it and other people don't have to do it. I know that's why a lot of people obviously love what you do. What is one or two kind of interesting factoids or tidbits that you've kind of posted in the last couple of weeks that you think is interesting for the listeners of this podcast, and maybe they don't realize it was just stashed on page 32 of some 50-page report by some bank?
So, okay, so I think there's two things that I think continue to sort of stick out that often get missed, and one's on the macro side and one is on the market side, so it's a little bit of everything for us.
Okay.
The first thing I'll note, and this is really basic, and maybe everybody does know this, or maybe people don't know this, but just really generic outlook for S&P 500 earnings. All the doomers and all of the, the tactical folks and all this stuff, and it's fine. There's a lot of interest in this stuff. Constantly talk about how estimates for 2023, 2024 S&P 500 EPS have been getting revised down for months. And you look at these charts, and they are all going down and to the right. It's the scariest thing that you'll ever see. But FactSet does this, and this is actually just information that's available out there. But even despite all those revisions, expectations are for EPS growth in 2023, and on top of that, there's expectation for growth in EPS in 2024. One of the biggest bears on Wall Street, this gentleman Mike Wilson at Morgan Stanley, he predicts lots of downward revisions in earnings, and he's very bearish on the stock market from a tactical perspective. But in his same research notes, he talks about 2024 and how he thinks that there's going to be a big inflection point coming, and how he thinks that, thanks to operating leverage, you're going to see a huge surge in S&P 500 earnings from a very low base, of course, but he does see a pretty big acceleration where, 2024 earnings is something to be excited about because it's going to be higher and it's going to be at record levels. And, as we all know, the stock market discounts the future. I think there's, to a certain extent, it might be the case that, one of the reasons why markets are resilient is not because they're so worried about 2023 earnings. It might be because people are looking at 2024 and beyond. So that's one thing I think is kind of interesting, is that the market, the street, the consensus expects growth 23 and 24. The second thing I would point out that I think, is really important is, and this comes from The Economist, and this always gets buried. I don't know why, but this is probably one of the more bullish macro indicators. But within the JOLTS report, the Job Openings and Labor Turnover Survey, maybe one of the more interesting stats in there right now is hires, the hiring rate. Now, we see in the news all day long, different tech companies laying off employees, and even at the aggregate level, the JOLTS report will tell you that there's, I think it was we're updated through about January, but on a monthly, U.S. employers are laying off about 1.7 million people a month. Now, that's a staggering number, and every single one of those 1.7 million, that's really terrible. It's very challenging. But here's the truth. The truth of the matter is 1.7 million layoffs per month is business as usual. This is actually lower than the number of monthly layoffs that we were having during the pre-pandemic levels. So layoff activity, believe it or not, is actually lower than where we were at the pre-pandemic. But what I think is so important about hiring is, before you see mass layoffs, ripple across the country, and you have a major labor market slowdown, you have to have hiring freezes. Companies will stop hiring. Jobs get vacated, but maybe they don't backfill positions. Hiring, okay, so you have 1.7 million layoffs per month. There are currently 6.3 million hires happening every month, and that is higher than pre-pandemic levels. So this is a reflection of how strong the labor market is from a demand perspective, and it helps to explain why unemployment is so low and jobless claims are so low.
Well, I'll jump in. Sonu, go to you in 1 second. Just let me jump in. So just so you know, you said, here's the truth, I think is what you call it, what you just said. I think that's to be a great name for like a podcast, right? Like, here's the truth, that's good. But just so you know, also,
I think the name of your podcast actually nails it.
Well, that's thanks to Joey, our producer, who came up with
Yes.
that. But nonetheless, one more comment there. And actually, no, I got sidetracked. What I was going to say. I don't know. It's something really smart, I'm sure. But Sonu, go ahead and jump in there.
No. Speaking like that's so important, and we try to give that context. I mean, when we talk to our advisors as well, like the
Time out.
right?
I do remember. Sorry.
Yes, there you
Just
go.
real quickly. I knew it did come to me. You mentioned Mike. I'm a big fan of Mike. I like his research. But just so you know, I mean, hopefully, if you follow us, Sonu and I have a glass half full attitude here. We don't see a recession. We see probably better earnings. We are overweight equities, moved to overweight equities in late December. When everyone was worried 2-3 weeks ago, we actually added some equity risk to some of the models that we run for our Carson partners here, Sam. So we're kind of on this lonely island where we don't see the end of the world, and that's anyway. It's a lonely island, but sometimes being lonely can work when it comes to investments. Just so you know. Go ahead.
You mentioned it's like we're recording this at the end of the quarter, and it's amazing. Like, there's only 9 months left for 2024. I mean,
oh my god, yeah,
right.
I still gotta book my Thanksgiving plans.
Yeah. So, connecting, your own personal story about, you mentioned, the 2008 recession, losing the job, and and then you just talked about tech layoffs, right? And this is something I think I read in one of your pieces, I think fairly recently, how there's some opportunity because, I mean, I love this line you wrote about, maybe engineers in Silicon Valley can figure out how to make glasses that don't fog up. Right. I mean, maybe there's opportunity for them to be dispersed across other industries. I know.
Yeah.
Well, I'm at contact, so.
Sure. So that was actually building off of a research note that my good friend Kai Wu of Sparkline Capital wrote. There's a research note out there that's freely available. Anyone can download it. And he looked into data on some of the publicly available like sites like Indeed and LinkUp that have job listings and like show how this stuff works. And something that he has noticed is that as the tech big tech companies have been retrenching in terms of hiring, and they've been obviously making a lot of layoffs. A lot of these companies that aren't traditionally tech companies are hiring for tech jobs that require high tech skills and programming language and all this kind of stuff. And again, nobody likes being laid off, and it's very difficult. And especially if you have obligations, very very challenging time. From a macro perspective, it's really interesting to see where we're going to be in 5-10 years with this upheaval, because if I think generally speaking, if you're relatively early in your career or even late in your career, you're probably not ready to just retire and go move to Turks and Caicos or whatever it might be after making a couple $100,000 at Silicon Valley. But I think a lot of these people will end up landing at some of these other places that have been starved for good tech talent. Now remember, like for the last maybe decade or so, maybe even 2 decades, it used to be that the war for talent was for Wall Street. They're going to pay you $1 million a year, and they're going to hire every physics major to help their quant hedge fund figure out how to arbitrage a couple cents here and there. And then VC money flows into Silicon Valley, and everyone wants to take part of that high growth. And suddenly, it's all the big, gigantic, high tech companies that are sopping up all this talent. And it's just incredibly difficult to offer what might be what is actually great pay, but it's never going to be as competitive as what some of the other firms are. So, fast forwarding, I wonder what happens when some of these incredibly brilliant, talented folks, make their way over to some of these companies that need some upgrading. I mean, like it was just December. We were getting over Southwest Airlines having all these outages because their software was outdated. Mm-hmm. Now maybe it's part of CapEx spending or whatever, but you wonder what happens when and not to say anything against the folks that they had on their team, but like what if you have like the person who won some award at MIT or Stanford who's now running IT at your industrials company, and see how things turn around from both a margin perspective and an innovation perspective. So who knows what happens, but all I know is this: the unemployment rate is still very low. which means these laid off folks aren't, answering the BLS and telling them that I don't have a job, but I'm looking for one. And initial jobless claims are continuing to be low, which means, I think some of these people are landing at some of these other firms. So that's got to be exciting from not just the income continuity perspective, but what happens when some of these non-tech firms start launching things that you just never saw coming.
Maybe even in Omaha. I mean, shout out to our own tech team at Carson. I mean, Nimesh, our CTO, is building out a pretty amazing tech team, right, Ryan?
Oh, no, absolutely. I mean, one of the cool things about Carson is we're on the cutting edge of technology. Yes, we're a financial institution, we're an RIA, a lot of different things. But at the end of the day, if your tech isn't better than everybody else's, you're not going to grow. And that's one of the reasons I'm sitting here, because our technology that we're doing on the cutting edge to help our partners, to help our advisors, really to change the industry is special. And it's just special, Sam, that we've got you. It's amazing how quickly this time has gone. I've got two kind of more personal questions for Sam. Sonu, you might have time for one more. And unfortunately, we'll just have to have you back, Sam. More personally, TKer or TKer, whatever you want to call it. Just bottom line is, I am such a fan. We all are. How does it work? You can go to the website. I know how it works. I'm setting this question up for you. You go to the website. Some of it's free, but you can pay for it. I want the listeners to know to really check it out, because, again, I am a huge fan. I know we all are on the Carson Investor Research team. How can someone get your stuff, Sam?
Sure. So the website is TKer.co. So that's TKer.co. And the first thing that you might actually see is a prompt to sign up. Now, there's a free tier and there's a paid tier. As a free subscriber, and everybody gets this, paid and free subscribers, get a free newsletter every Sunday where I offer a little bit of commentary as to my view of an assessment of things based in, again, all based off of either insights from experts I speak to or data that I'm looking at. And it also provides a roundup of macro events from the past week. So, if you're busy during the week and you have 3 minutes to catch up on all the data and stats that you're looking to catch up on, TKer.co, we have a free newsletter that goes out every Sunday. Paid subscribers get a couple more emails during the week. And these are opportunities for me to sort of dig deeper on specific topics, or maybe new topics that get surfaced. So stuff like, insights about hiring that some economists have pointed out is something that will go out to paid subscribers during the week. Me seeing interesting research that no one's talking about, like this whole matter of high-tech workers moving to, these sort of quote-unquote old economy jobs. Paid subscribers get that. Free subscribers will, often get, samples of stuff like that. But to each their own. But if you do head over to the website, you do have the opportunity to, I think it's either 7 days or 14 days, whatever it is. There is a free trial period to see the paid content, which also gets you access to all the archived content. And that's actually a really important part of, the TKer experience, if you will. I'm not here writing about, the day in and day out and information that's going to be very ephemeral. I'm trying to provide data, insights, research that has a lot of shelf life. And as a result of that, a lot of what I end up writing about on a daily or weekly basis links back to stuff that I've probably been writing since I launched TKer. So come to TKer, say that you heard me on the Carson podcast, and maybe I'll even toss you a couple of months for free.
Oh, there we go. There we go. Yeah, I mean, I love how you link back to some previous ones. So again, we're huge fans. Definitely check it out if you're interested in learning a lot more, because again, Sam does the heavy lifting. Now one more fun one from me, and then Sonu, you've got one more, and we probably need to wrap it up. Sam, you're from Louisville. Am I correct?
That's right.
All right. So here's my Louisville story. The Kentucky Derby in, I think, 2000. I was in college. Like, you're not supposed to bring alcohol in. I'm telling you, the amount of alcohol we snuck in had to have set some records. I had one. You mentioned technology. I had a buddy who spent all night working on a big jug of water. Somehow, Sam, I don't know how, he took the cap off without like breaking the seal. Then, of course, we filled it totally with vodka. Do you have any fun Kentucky Derby stories growing up in that fun city?
So I'll there's actually two answers to that. So,
boy, is one of them after we stop recording?
Yeah. Well, okay. So,
I was in college, by the way, when we did that, so I don't do that stuff anymore. Full disclosure.
Yeah. So I was
You
a
go to
little
the
bit
Derby, you're in
younger.
college. Funny.
I
I saw one horse. I was there all day, go to the infield and just party.
Yeah, the
I
infield.
saw one horse the whole day. I didn't go to look at
the
horses.
infield is completely different from what's going on in the stands, right? Like, there's not a lot of
it's a different world in that infield.
So I come from the Louisville, Kentucky experience of being the son of a Southern Baptist minister.
Oh,
so things are a little bit more buttoned up on that end. I will. We did have my high school senior prom was at Churchill Downs. They actually have a nice little museum that you can reserve off and all that kind of stuff. And I'm not. I'll say in the third person that it's not a facility that's very difficult to sneak alcohol into.
There you go.
So it's completely dry, is it? Is that right? Like they don't have?
No. They want to sell you. They want to sell you their own alcohol. That's
Okay. Yeah.
Oh, it's like in the infield, you can bring an icebox in with water and fruit and all this kind of stuff, but you have to hollow out the watermelon in order to not get price gouged at the stands where they're selling you mint juleps for $25.
Yeah.
Tricks of the trade, hollow out a watermelon. So, But how much time do we have, Ryan? Do we have?
This is probably about the last question, unfortunately.
Right.
So make it good, Sonu.
All right. You know what? Let's go back to like the career and all of that and online conversation, right? I know all of us track that, and one big thing everyone's talking about right now is ChatGPT and AI, and so I'm curious what your thoughts are. I mean, it seems like everything online, it's on either end of the spectrum. It's either 1 or 0. It's like either it's Terminator 2 or it's like, oh, this thing doesn't matter at all. Curious how you look at it.
Yeah, I think maybe it's kind of like Terminator half. So I think of it kind of two ways. First of all, when you learn that something is written by AI or you read an article, sometimes it's like you kind of pick up on it, and sometimes there's this kind of a soul that's lacking in the writing. But but that's neither here nor there. If it's about people seeking information, then maybe that's just fine enough. But as someone who's been an editor in media for a little bit over a decade. One of the things that's most time consuming for a lot of reporters is just drafting the copy for whatever it is that they're reporting on. And, not that anyone's like a good or bad writer or anything, but sometimes it's like, well, the business model is really tough, and, you might have extremely talented reporters and incredibly talented thinkers who have a piece of data or who have a scoop, who have a piece of information, who, can get the information, the facts, and if you can throw it into the machine and the machine will draft your story for you, then there could be some real advantages there, because sometimes Ryan, you write, and I'm sure you're an outstanding writer, and I think I'm pretty decent, but sometimes it takes a little bit longer than you want to write a piece of content to provide all the context around the information that you're providing. So I think there will be some instances where ChatGPT and chatbots end up sort of like it's like juicing your reporter or writer's ability to file copy more quickly. But I'm not totally convinced this is going to start replacing everybody in droves, because you still need an editor, and there's still a lot of judgment calls that need to be made along the way. So on one hand, I think there's ways to use it, like especially like in coding. Like you talk to all these people who are in coding, and it's like it makes perfect sense. But generally speaking, I think it's something that ultimately helps us enhance productivity.
That's great perspective.
That's great. Yeah. Well, Sam, this was awesome. From Sonu, myself, everyone from the Carson Group, and the 28th episode of the Facts versus Feelings podcast. We really appreciated it. Sam, I'll give you the final comments, final anything you want to say on the send-off here.
Yeah, just for everybody, be really cautious about negative headlines and negative things that you read. The truth of the matter is, we live in a world of uncertainty, and there's a lot of crises that will emerge. That's part of investing. You have bad years, things bad happen in the economy. But if you are one of these folks who are investing and saving for the long run, you got to think about what the world looks like on the other side of crises and tough times.
Love it. I'll just say this, Sam. If you ever want to go in the investment research, we might be hiring. So I think you fit on our team. But I think what you're doing on your own and working with the industry and just how you're helping so many people. I mean, you do a lot on Twitter too. By the way, follow Sam on Twitter. I mean, he gives a lot on Twitter. So definitely check that out as well. But with all of that, the pre-spring break edition of the 28th episode of Carson's Facts versus Feelings is signing off. We'll see everybody real soon. Thanks again, Sam. Take care, everyone. Bye-bye.
Thanks, guys.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.